Thank you very much for watching. Hi,
Daily classroom for CSEC and CAPE students. You can watch this lesson real time on Television Jamaica's YouTube channel or OneSpot Media. We are also live on Music 99 and GoJamaica.com. If you have questions on today's subjects, you can send them in to Television Jamaica's Facebook page or Instagram at television_Jamaica. Today's lesson is agricultural science. We'll be focusing on farm budgets. I am Alton Lawrence. Yes, today we're talking about farm budgets. But what is a budget, right? Let us get right into the meat of the matter. Before we get into the farm budget, let us look at the objectives, should I say. And the first objective that we have here is to define the term budget correctly, followed by preparing a partial and complete budget for a theoretical farm, because that is the business that we are in today. And we're going to distinguish between gross farm income, gross margin, and net profit, followed by understanding the relationships between budgeting and a sound decision making. Now, what is a budget? A budget is a financial plan and a list of all planned expenses and revenues over a period of time. As we said earlier, agriculture is a business and we're into the business of making profit. So we must make sure that a budget is created for us to be profitable. While making a budget, it is important that we understand budgeting. Now, budgeting is a management tool for planning and controlling all future activities that will take place on your farm. And as I said earlier, your activities can come from expanding the farm for changing of the activities that actually takes place on the farm. Now, let us look at the types of budget. There are three main types of budget. The first one is a complete budget, followed by a partial budget and a cash flow budget. Now, what is a complete budget? A complete budget is a summary of the expected income, expenditure, and profit for a given farm plan. So this would be all what is happening on the farm, all that is spent and all that is created. So it is money earned and money spent. And you will be looking at the business end of it at the end of the day to find out if you had made a profit or you have made a loss. A partial budget. A partial budget is used in situations that require change in a farm plan. Example, rearing 1,000 rabbits instead of 800. So in the initial stage, you had budgeted for 800 rabbits, but now you have increased your projections to 1,000. That would have been 200 more than what you have originally budgeted for. So some things will change. Your utilities will change, your labor cost will change, and your expenditures will go up. So we have to understand that we're making a different change while creating a partial budget. Cash flow budget. A cash flow budget is a summary of all the inflows and outflows of money into a business over a period of time. This can be seen periodically every 3 months. You have business telling you that they have made a profit in the first quarter, the second quarter, the third quarter, or the last quarter. So it depends on what is happening at the business. So it's money cumulative over a period of time from the first quarter to the final quarter. Having a budget must have some importance. So what is the importance of having a budget? Firstly, you want to make sure that you're planning for future course of action. Let us look at COVID-19, for example. No one knew a year ago that we would have COVID-19 now. But it is here and it's affecting everybody, especially us in the business of farming. So this COVID-19 now will prepare us for future course of actions for the farmers to survive, given the nature of what is happening today. It is able to coordinate operations of various departments. So we are making linkages for different departments. So you're thinking about the agro-processing department, you're thinking about the field cultivation department, you're thinking about the maintenance department. So you see how you would put all of these departments to accumulate the activities together. It serves as a guide for different actions to take place on your farm. So it tells you when to plow the land, when to do your spraying for your crops, and it also tells you your harvesting. So it gives you a projection of the different types of things that will happen there. It helps in sound decision making. And if you can see, our stakeholders here are involved in a serious meeting now, right? So they are making sound decisions on the plans for the future of that farm. But in this present COVID-19, we are unable to meet in such a fashion. So what we have been doing now, meeting via Zoom. It helps us as a tool for communication. So having your farm budget, it helps us to make us having sound knowledge of what is to come, and it helps us to communicate and have the different linkages, example, the marketing areas. For example, now in farming, agriculture is taking a beating, so we have to find ways in finding the farmers. So we're taking the excess crops from the farmers and finding them where it is most demanded. It provides also feedback based on what is happening. So the feedback you get from your budget, it tells you where sales are needed, and it tells you the demands that you need to have. And also it identifies problem areas that we can identify from time to time. For example, what is happening on the farm? Do we have a present disease outbreak? Do we have less of a crop growing because of a drought? So it identifies different things. So it is a very useful tool. So having done a budget, we must think of the advantages of having a farm budget. So some advantages of having farm budgets start with it evaluates the old plan and guides the farmers to adopt to new principles. So you have to take a new plan based on what happened the previous year or years. So you can maybe change in the outlook of your farm. You may be changing the nature of what you produce on the farm. So it helps us to make sound decisions for future operations. It makes the farmer conscious of waste or leakages in the farm business. So whenever you have something that there's a decrease, we want to know what is the cause of this decrease. Is it because of poor management skills? Is it because of a disease outbreak? Or is it because of a disaster? So it will help us to give us sound decisions. It gives comparative study receipts of expenses and net earnings on different farms in an area. So we have, say, 3 dairy farms in a particular community, and we compare them. The prices are the same, and all the factors basically are the same. But at the end of the day, 2 is more profitable than 1. Now we have to compare and look at it. It could have been poor decision making that is causing one to suffer. So when you analyze these records or these data, it helps the farmer or that particular farm to be in a better position for future. It guides and encourages most efficient and economical use of resources. There are some parishes at this time that is experiencing a drought. So the most efficient use of water may not be used in a sprinkler irrigation system. It might best be suited to use a drip irrigation system that water is needed or used just as wanted by the plant. It serves as a valuable basis for improvements in farm management practices. And there are some farm management practices depending on what you have. If you have animal husbandry or crop husbandry. So for example, you have an outbreak of a disease on the farm. How you treat that disease may tell you how profitable you are. So if you have crops being affected by a particular disease, those crops should be taken out and be burnt and not mixed with the other crops, because you'll be contaminating the entire field. Okay? And it would have been the same process for animals. You would have culled them and removed them from your flock of animals so your farm can be profitable. These are some terminologies to be used while we think about budgeting. The first one is expenditure. Expenditure It's all the money that's spent over a period of time when operating the business. For everything you do, you buy your fertilizer, you buy your seeds, you pay for labor costs, you do for your depreciation, your taxes, and all the insurance, all that money that is being used on the farm over a period of time. Income. What is income? Income is the total sales of goods and also the service that the farm supplies. So if you're in the business of selling tomatoes, the money that is earned from the sales of the tomato becomes part of your income. But if you have additional machinery on your farm, you could be in the business of providing a service to smaller farms where you go and you do land preparation for them. You could also do fertilization for them. So that's a service you provide, and all of this will provide an income to the farm. Your net farm income refers to the return, both monetary and non-monetary, to farm operators for their labor, their management skills, capital, and all other production expenses that have been paid. So over time, you would have seen it's a profit of all the things that you have done, your sales minus your expenses. Net income. Net income is the residual amount of earnings after all expenses have been deducted from your sales. So whatever is left, all your sales, all your expenses, and you take them away from your income, whatever is left over is your net income. And this shows if your business is operating at a profit or a loss. Gross income. The gross income is the amount of salary or wages paid to the individual by an employer before any deductions are taken. So nothing is taken from it, so that's the gross. But after you make your deductions now for the different taxes now, that is what is left. Net profit. Net profit is simple. It's the actual profit after working expenses not included in the calculation of the gross profit that you have been paid. So everything that you have been collecting, and you subtract the differences. So what is left with you now becomes your net profit. And your gross margin is the company's total sales revenue minus the cost of goods sold. And this is divided by total sales. And this is always expressed as a percentage. Variable expenses. These are expenses that a farm or each farm has to come in contact with. The variable expenses are the costs that change as the quantity of the good or services that the business provides changes. So these can be your seeds, your seedlings, your labor costs. These will change from time to time. Your fixed expenses now are the business expenses that are not dependent on the level of good or services produced. These do not change. So these include your depreciation, your insurance, and your loans. Let us look at a complete farm budget. As we mentioned earlier, that was one of the first budgets that we looked at. So complete farm budget. A complete farm budget is also known as a whole farm budget, as it looks at the entire operation of the farm. It is prepared for a farm with a new owner or a new manager. New management skills are needed, right? So if you have this farm budget prepared for a new farm, it will tell you the future earnings or the future business of this farm. It also be used when there's a major change in resources or enterprise of a farm. So you could have been in the production of crop plants, okay? And now you decide to make a change to animals. So you were producing tomato plants and cabbage, and now you're going into animal husbandry. You're producing milk from dairy cattle. So there's a total change. So this is a whole farm budget. It's a different operation. It usually prepares when an existing farm wants to change the system of production and introduce new technology. Presently, farming as we know it is done mostly on the outdoor section. But if we should improve new technology and introduce it to our farm, we are using, for example, a greenhouse technology method, where we are growing crops under protective structure. Now we'll have to look at the different technology that is incorporated and see how best it fits us. So a new arrangement will have to be made. Let us look at this example in terms of a complete farm budget. We're looking at the income here, and the income is coming from what is sold. What are sold here? Pak choy and sweet pepper. And we're selling pak choy 100 bundles at $50 per bundle, and sweet peppers at $150 per kg. $100 per kg, and we have 150 kg. So the total income here is adding the cumulative of both would have been 5,000 plus 15,000 is equal to $20,000 over there. And look at the variable expenses there. We have seedlings, fertilizers, pesticides, and labor, and this changes from time to time as the cost or the price will change. And if we add all of the total variable expenses would have been, adding all three, the 12,000, 2,300, 1,200, and 4,500 will give us 9,200. So we are adding variable costs. This is the total variable expenses, the seedlings, the fertilizer, pesticides, and labor. All those there. Let us look at our fixed expenses. These do not change, as I said earlier. And we're looking at here, we're presently looking at our taxes, which is $1,000, your loan interest, which is $1,100, and your interest, which is $1,000. This will give you the total fixed expense of $3,100. So look at the income above for variable expense. It would have been the total income that we had earlier. The sales from those goods have given us $20,000 minus the 9,000, that is the total variable expenses, which would have been 9,200. So we are left with 10,800. Total expenses now. So we are looking at total variable expense minus the total fixed expenses now. So we are looking at 9,200 minus 3,100. This is equal to 12,300. So to find our profit, we'll now subtract our total expenses from the total income. So the total income, as we started out earlier, we had $20,000 from the sale of the pak choy. And we have the total expenses here at $12,300. So we are subtracting the difference of $12,300 from $20,000, leaving with a total of $7,700. A partial budget. We are looking at the partial budget and see how it benefits us. When you have a partial budget, we have additional costs that were not included. They did not exist at the current time, and these changes are made. So a partial budget is needed. As we said earlier, we spoke about having an enterprise that we are rearing rabbits, and these rabbits were 800 in total, but we have changed the operation to 1,000. So there's a difference of 200 rabbits now, and we have to cater for these 200 in terms of the expense and the additional cost that comes with them. We have reduced revenue. You have reduced revenue always goes with an additional cost. So revenue that is currently received but will be lost or reduced if changes are made. So the revenue you'd have gotten from the 800, because of the additional cost you're using to cater for that 200, you would have been losing there or reducing. The additional revenue now, revenue to be received is alternatively adapted, and this will increase. And you have reduced costs or costs that are incurred, which would be eliminated if changes are made. And if you have additional costs, you will have reduced revenue, and additional revenue, you have reduced cost. Let us look at a partial budget form. As we said earlier, whenever you have an additional cost, you have a reduce in terms of revenue, reduction in terms of revenue, and additional revenue, we have a reduction in terms of cost. A partial budget continued. Let us look at it. There's a change for rearing broiler birds. We are rearing 1,500 broiler birds instead of 1,000. So there's an additional change of 500. So look at the additional cost now. We're looking at the variable cost here. We're looking at starting with 1,500 chickens, 15 broiler birds. So the feed cost there would have been, say, 3,000, and the medication cost would have been $325. So the total there would have been $4,825 for our variable cost. So that would have been the total variable cost there. Total variable cost. So look at the fixed cost now. There's no fixed cost. So it remains as nil. So if you add your fixed cost, which is nil, to the total variable cost, to the Total variable cost, you'll have 4,825 brought forward. And then you look at your reduced income, which is none, and we have a total on the debit side on your left here, which would have been $4,825. But if you look at the additional income that is here now, we look at 2,000 kg of birds. That's poultry meat. And we are selling that poultry meat at $9 per kg. So 9 times that 2,000 brings us to a total of $18,000. Now look at the reduced cost. So we are subtracting now this total of $4,825 from the $18,000 to find out what is our new profit. So our profit margin there becomes the subtraction of the total debit from your total credit. And as I said, the total credit here was $18,000. So there's a difference of $13,175. Example of a cash flow. As I said earlier, the cash flow refers to the money earned over a period, and these are normally done in quarters, and quarters is the 3-month period, the first quarter, the second quarter, third quarter, and fourth quarter. Let us explain a bit here. Look at our cash flow here. For the beginning, we have a cash balance of $5,000 that is coming forward from last sales, and the sale of crop products is also, and sale of livestock is $25,000. And you have government pay. So all this is equaling to total inflow of $30,000. If we look at the cash expenditure, seeds and feed would have been $10,000 equally. So we have a $20,000 down there for your cash expenditure. But we had $30,000 as inflow in the initial stage. So we are subtracting $10,000 from $30,000, giving us a total of $20,000. So the quarterly net cash flow here would have been $10,000. And we are having a cumulative net cash flow that is bringing over to the second quarter, which is $10,000. Now look at what took place in the second quarter. In the second quarter, we had $50,000 there. So that was a total cash inflow. But the expenditure, as we looked here, we found $20,000 and also another $10,000 here. So our total would have been $30,000. So if we are subtracting $30,000 from this $50,000, we are now left with $20,000. And if we add this $20,000 to the previous quarter, the cumulative for the second quarter would have been $30,000. Look at the third quarter. We had no cash inflow. No cash inflow we had. But our cash expenditure continues. We had at $25,000 there. We had $10,000 for processing, we had $5,000 for capital purchase, and debt payments, we had $25,000. So we are there taking negative $25,000. So we are left with $5,000. If we subtract this $25,000 there for that quarter, from the previous quarter, the $30,000 we had, we are left with $5,000. And look at the fourth quarter. We had $10,000, $10,000 coming across for government payments. So as a total inflow of cash into the business. And then we go across and we looked at the cash expenditure. Again, we have $5,000. So this would have been $5,000 from that $10,000. So we are now left with $10,000 for that final quarter. We are looking at some questions that you would have come across. And these questions is more likely that you would have seen. Or CSEC exams this year is expected to be in a multiple choice format supported by the SBA content. Now let us look at the first question. Which of the following is not a fixed cost? We have A as fuel, B as taxes, C as machinery, and D as depreciation. So based upon what is here as a fixed cost, we know that fuel prices, this will alternate based upon the nature of the business that is happening in the environment. So fuel would have been the answer. The first answer for number one would have been A, as in apple. The other question followed said, which of the following pair of terms is used to calculate net farm income? We have A, gross income, and expenditure, B, capital and net income, C, productivity and inventory, and D, profit and loss. Our answer there would have naturally been A, which would have been the gross income and the expenditure. Number 3, a budget. A budget is a useful decision-making tool, and we spoke about that earlier. Very important in you have to have sound decision-making in terms of creating a budget. So it's very accurate in the absence of records. That's for A. B, predicts production, estimates, and future prices. C is used to calculate the depreciation cost. And D is an audited statement of the past year. So a budget is very accurate in the absence of records. So over time, the budget is necessary, but also it predicts production and estimate for future prices. So the best answer here stated would have been B, predicts production estimates and future prices. And the fourth question now would have been: a farmer intends to increase the size of his livestock farm by building an additional pig unit. Before doing this, the farmer should first do what? Prepare A, a complete budget, B, a farm inventory, C, a partial budget, or D, a production record. So you said the farmer intends to increase the size, so we have to go with a partial budget, which would have been C. The fifth question, a plan indicating how the farmer intends to invest his resources is best referred to as what? And we have just gone to this main topic, which is a budget. So it's not an inventory, it's not a capability map, it's not an expenditure account, but we say the answer is a budget. This is a practical question that we want to look at for today's class. And we say, Farmer Brown bought 100 day-old chicks. These are broiler chicks that you will be growing on your farm over a period of 6 weeks. Each bird at the end of the 6 weeks will weigh an average of 4 pounds at dress weight. Using the information that we have been given below, we are going to calculate his profit or loss, because having a business doesn't mean you're always going to be operating at a profit. It can be at a loss. And we're going to see how many pounds of feed that were used on the farm and the number of bags of feed. We must make note of some critical information. At the end of the production, the meat that is produced will be sold at $200 per pound. One bag of feed that he used on the farm would have cost him $1,700. You would have had miscellaneous of $5,000, that for any casualties or any emergencies that are needed on the farm. And FCR. And the FCR here is 2.5 to 1. But I should have mentioned earlier, the FCR would have been the feed conversion ratio. And that is the amount of feed each chicken will take on to produce a pound of flesh. And we're saying that each chicken here was averaging 4 pounds of meat at slaughtering. So we're saying that 2.5 multiplied by 4, which is giving you 10. So each chicken here is consuming 10 pounds of feed to produce this 4 pounds of flesh. And the last, we're looking at a chick, which is purchased in this 100 here. Each chick costs $110. And during the medication process in the early stage of the chicken's life, we are using 3 packs of dewormer, $150 each, antibiotics for $19.50, and also 50 bags of sawdust for the litter for their cushion that we walk on. And these are sold at $50 per bag. Now, let us look at this question and let's just see. Okay, so we'll continue and we'll move after the break. But let us take a wrap. If you have any question on what we have done so far, you can send them in on our various platforms, and I will see if I can answer in the final segment. When we come back, we answer your questions and wrap up. Stay with us.
COVID-19 tip. Protect yourself and others from getting sick by washing your hands after coughing or sneezing, when caring for the sick, before, during, and after you prepare food, before eating, after toilet use, when hands are visibly dirty, and after handling animals or animal waste.
Reduce your risk of viral illnesses like the flu and coronavirus. Wash your hands frequently with soap and water. Cover your nose and mouth when coughing with a tissue and dispose of it. Avoid close contact with anyone with a cold or flu-like symptoms. If you become ill, please visit your doctor or the nearest health center and share your travel history. The flu and coronavirus can kill. Let's protect each other. A message from the Ministry of Health and Wellness.
The Ministry of Education, Youth and Information, along with TVJ, present Schools Not Out, CSEC and CAPE lessons live Mondays to Fridays from 9 a.m. to 12 noon, with weekly Schools Not Out tutorial sessions on Saturdays from 1 p.m. to 4 p.m. Schools Not Out, live CSEC and CAPE lessons here on TVJ.
COVID-19 tip. Protect yourself and others from getting sick by washing your hands after coughing or sneezing, when caring for the sick, before, during, and after you prepare food, before eating, after toilet use, when hands are visibly dirty, and after handling animals or animal waste.
Reduce your risk of viral illnesses like the flu and coronavirus. Wash your hands frequently with soap and water. Cover your nose and mouth when coughing with a tissue and dispose of it. Avoid close contact with anyone with a cold or flu-like symptoms. If you become ill, please visit your doctor or the nearest health center and share your travel history. The flu and coronavirus can kill. Let's protect each other. A message from the Ministry of Health and Wellness.
Welcome back to Schools Not Out, your daily classroom for CSEC and CAPE students. Today we have been discussing CSEC agricultural science farm budgets. Just before the break, we stopped at looking at this question, and we are looking at how we can complete this projected budget. And this is part of your SBA research that you would have been doing on the school laboratory. So we are looking at Farmer Brown producing 100 chickens. And I'm going to be working this maths today for you. We'll be working it together. And I hope that we can follow as you go in TV land. So we say, Farmer Brown bought 100 day-old chickens, right? And we're going to look at the cost. So 100 day-old chickens, and each chicken costs $110. So first, he purchased 100 day-old chicks. And this was done at a cost of $110 per chick. So 100 times the 110. So that's $11,000. We're looking at the mortality. The mortality that is as shown there would have been 6%. So there have been 6% from the total flock of 100. So he lost 6 chickens. So we are working for 94 chickens, okay? Look at some things that he bought. Some things that are there. He bought 3 packs of dewormers as well and an antibiotic. So 3 packs of dewormers would have been 3 times 150. Which is equal to $450. All of these are in dollars. And they had a antibiotic for $19.50. So let us work what is happening there. We need to understand that he produced 94 chickens at the end of 6 weeks. And these chickens were averaging dress weight of 4 pounds. So 94 chickens. 94 by 4. 4 nines. 376. So he had 376 pounds of meat. And for this 94 chickens, we're going to calculate now the FCR in terms of the quantity of feed that these chickens have been eating. So 94 chickens, right? So 94 would be using, each chicken would have been using 10 pounds of feed, as I said, because I said 2.5 pounds of feed to 1 pound of flesh, and each chicken is weighing 4 pounds. So 4 pounds times 2.5 would have been giving you that 10 pounds. So 94 times 10 equal to 940. So 940 pounds of feed. And we know that 50 pounds of feed is in each bag. So we're going to calculate the amount of bags of feed. So we are going to calculate the amount of bags of feed that is required. So we're going to do all the expenses here, then we subtract and find the profit. So we are going to be using 94 divided by 940 divided by 50, which is equal to 18.8. So we just round off to 19. Because we don't buy a fraction of a bag. So we have 19 bags of feed. And we have 19 bags of feed sold at $1,700. So it's that multiplied by 1,700, which is equal to so this would have been the largest price so far that we have been paying. And we have miscellaneous. And that would have been equal to 5,000. And the sawdust that we bought 50 bags times $50 per bag would have been equal to 2,500. So what we're going to do now is to work the difference in terms of looking at if the farmer was able to make a profit or a loss. So the first money that we're going to need to add here would have been the cost of the day-old chicks, would have been 11,000. We did the price for the dewormer would have been 450, 1950 for antibiotics, and we purchased feed, which cost us $32,300. We have miscellaneous of 5,000 and sawdust for $250. Now we are left with a total of 2,500, should I say, sorry. And that is a total of 53,200. So that's our total expenditure so far. But at the end of the day, we must remember that we sold 200 pounds of chicken meat. And the 200 pounds of chicken, we sold chicken meat here, and it was 376 pounds of chicken meat. So 376 here, multiplied by 200, which would have been equal to 75,200. So to arrive at a profit or a loss, now we will have to subtract our total expenses from what we have received from our total sales here. And the total sales would have been 75,200 minus 53,200, which is equal to $22,000. So this is an assumption on a theoretical form that this person has been making $22,000, barring that there are no utilities to be paid, so there is no labor cost. So that brings us to the end of today's class. That's all for today for CSEC Agriculture, Science, and Farm Budgets. We hope you grasp most of the concepts discussed. You can catch a repeat of today's lesson on JNN today at 4 p.m. and in the Schools Not Out highlights on Saturdays between 1 and 4 p.m. right here on TVJ. We are also on video on demand at One Spot Media. Until next time, I am Alton Lawrence. Pleasant viewing, stay safe, and remember to wash those hands. Thank you.
Hi there, I'm Simon Preston from TVJ. Thank you very much for watching our YouTube channel. To see our latest videos and also to see live events, click here. To see our full videos on onespotmedia.com, click here. Thank you very much for watching. Hi there, I'm Simon Preston from TVJ. Thank you very much for watching our YouTube channel. To see our latest videos and also to see live events, click here. To see our full